Welcome to the deep dive. We're here to cut through the noise, get straight to the insights, the stuff you really need to be properly informed. Today, we're jumping right into a really fascinating collision point. The structured world of traditional finance meeting let's call it the dynamic world of crypto. Our mission, really, in this deep dive is to unpack the Basel III framework, and specifically that SCO 60 document from the Basel Committee on Banking Supervision. We're going to look at how it's way more than just dry banking rules. It's actually this powerful kind of stealthy force reshaping, everything, crypto policies, taxes, even the whole global competitive scene for digital assets. Think of this as your essential shortcut, understanding what's really at stake for banks, for crypto, and yeah, for you listening. Okay, so let's get into it. Basel III, it came out of the mess in the 2007-2008 financial crisis. Pretty simple goal, make banking stronger. But now it's sort of shaking hands, maybe grappling is a better word, with the crypto world. So what is this SEO 60 document exactly? And how is it trying to bring some order to, what some people still call the Wild West?
Right. Okay, so SCO 60. This is where it gets genuinely interesting. The Basel Committee on Banking Supervision, the BCBS, they've been around since '74, set up by central bank governors. They finalized the standard back in December 2022. And SCO 60, well, it's a big deal. It's the first proper regulatory framework that actually explicitly allows banks to hold and trade crypto assets.
Ah, okay. So it's not just about restriction, it's also enabling in a way.
Exactly. And this is the key part, it sets out very, very detailed and often pretty heavy capital requirements for doing so.
Yeah.
And look, for anyone in this space, you need this date in your diary. January 1st, 2025. That's when it kicks in.
Wow. Okay, that's coming up really soon. That must be putting a lot of pressure on banks right now.
Immense pressure. They have to adjust strategies, portfolios, everything. It's not far off at all.
So with this framework going live so soon, how are banks supposed to navigate this? I mean, I assume they didn't just say go nuts with crypto.
No, definitely not go nuts. They built a very specific classification system. Think of it like sorting bins. You've got Group 1 crypto assets. These are, let's call them the good list. They meet a whole set of conditions.
Okay.
And within Group 1, you've got two flavors. First, Group 1A, tokenized traditional assets. So basically, digital versions of stuff banks already know, like corporate bonds. And the really neat thing here, they get the same capital treatment risk weights from 0% up to 100% as the non-tokenized versions.
Right, so no penalty for putting a traditional asset on a blockchain, essentially.
Precisely. It makes holding familiar assets in this new format pretty efficient, capital-wise. Then you have Group 1B, crypto assets with effective stabilization mechanisms. These are, essentially your highly regulated stable coins. We can dig into what effective stabilization means later because it's strict.
Okay, Group 1A, Group 1B, that sounds manageable. What's on the other side?
All right, the other side is Group 2 crypto assets. This is firmly the risky list. These are assets that fail to meet any of the Group 1 conditions. So Basel sees them as posing much higher risks. And Group 2 splits again. You've got Group 2A, which allows for a tiny bit of hedging recognition, and then Group 2B, where basically no hedging is recognized at all. And critically, Group 2B includes all unbacked crypto assets.
Unbacked crypto assets. So we're talking Bitcoin, Ether, things like
Yeah,
that.
exactly. Your Bitcoins, your Ethereums, many others fall into this Group 2 bucket.
So what does this classification actually mean for banks holding, say, Bitcoin? Is the capital difference between Group 1 and Group 2 significant?
Oh, it's night and day. This is where it gets really interesting and frankly quite punitive. For those unbacked crypto assets in Group 2, banks holding them get hit with an exceptionally high risk weight of 1,250%.
1,250%. Did I hear that right? That sounds astronomical.
Yeah. You heard it right, 1,250%. It's not just a tap on the wrist, it's, as you said, astronomical. A financial sledgehammer, really. It's designed specifically to heavily discourage banks from holding or trading these assets directly on their balance sheets.
Wow. So Basel is basically telling banks, hands off Bitcoin. Is that a fair summary?
It's a very fair summary in terms of direct holding. This conservative treatment covers everything: credit risk, market risk, even CVA risk. It makes you seriously question if banks can ever really play a significant role with assets like Bitcoin under these rules. It's almost like an outright ban, just implemented through capital requirements instead of an explicit prohibition.
How does that 1,250% compare to, say, other risky assets banks might hold, like, junk bonds or complex derivatives?
It's generally much higher. Traditional risk weights rarely, if ever, reach that kind of level, even for very risky assets under existing frameworks. This is really singling out unbacked crypto. And there's more. A bank's total exposure to all Group 2 crypto assets combined. It should generally stay below 1% of its Tier 1 capital, and it absolutely must not exceed 2%.
1%. That's tiny for a bank's overall capital
It
base.
is. And if they breach those limits, even stricter rules kick in. The entire exposure gets treated as Group 2B, the toughest category.
Okay, so the limits are tight, the risk weight is massive. What else? Does this affect how they manage the risk?
Yes, crucially, banks are effectively barred from using their own internal risk models for Group 2 assets. They have to use the standardized approach dictated by Basel.
Which probably isn't as nuanced or potentially favorable as their internal models might be.
Exactly. So this raises a big question for the market, right? If banks can't use their sophisticated models, how does that impact their ability to innovate or even just participate meaningfully in these markets?
It sounds like it severely limits it. It clearly suggests a very strong steer towards those approved Group 1 digital assets.
That's the undeniable message, yes.
Okay, so if holding Group 2 stuff like Bitcoin is basically off the table due to these huge capital hits, what's the alternative? What is Basel encouraging banks to get involved with? You mentioned Group 1.
Precisely. Given those massive requirements for Group 2, the incentive structure clearly pushes banks towards Group 1. So let's talk about the assets getting the regulatory thumbs up. First up, central bank digital currencies, or CBDCs.
Right, CBDCs. We hear a lot about those. How does SCO 60 treat them?
Well, SEO 60 itself doesn't actually lay out the final capital rules for CBDCs just yet. It says the committee will provide more guidance later.
Ah, okay, so a bit of a watch this space.
Kind of, but crucially, it does say that if a CBDC is accepted as legal tender in its jurisdiction, it's naturally classified as a Group 1 crypto asset.
And what does that mean in terms of risk weight?
It means it would likely get a risk weight comparable to physical cash. So very, very low risk from a capital perspective. Essentially 0% in many cases.
Okay, that makes sense. And are these CBDCs actually happening, or is it mostly theoretical?
Well, they're happening. As of, say, mid-2024, you had 3 countries that had actually launched a CBDC. Something like 36 were in pilot phases, and another 44 or so were deep in research.
That's a lot of global activity. What about the U.S.?
The U.S. focus so far seems to be more on wholesale CBDCs, for transactions between banks, rather than a digital dollar for everyday people just yet.
Interesting. So what's the big appeal for the central banks themselves? Why are they pouring resources into this?
Good question. For central banks, CBDCs offer potentially greater control and efficiency. They can enhance how monetary policy works, giving them a direct channel for issuing digital currency. Plus, there's the financial inclusion argument, potentially helping people who don't have bank accounts. And as the BIS trials showed, wholesale CBDCs could make interbank settlements way faster and more secure.
Okay, benefits for central banks. But what about commercial banks? If the central bank issues digital cash directly, doesn't that cut them out of the loop?
That is the multi-trillion-dollar question for commercial banks. Yes. CBDCs could potentially allow people and businesses to make payments and store value directly with the central bank, bypassing traditional bank accounts.
Which sounds like it could seriously hurt banks' core business.
It could. It might reduce demand for normal banking services, deposits, payments. It could even impact credit supply if deposit bases shrink. Ultimately, yeah, it could undermine bank profitability quite significantly.
So banks need to adapt, find new models.
They absolutely need to adapt, and probably quite fundamentally, it's a major strategic challenge for them.
Are there other hurdles for CBDCs besides the impact on banks?
Oh yeah, plenty. Building secure digital wallets for everyone, individuals, businesses, banks themselves, that's a huge tech challenge. And cross-border transfers are especially complex because of all the existing KYC AML regulations. You mentioned the EU's MiCA travel rule earlier.
Right, requiring sender and receiver info.
Exactly. That makes crypto transfers, even potentially CBDC transfers across borders, no longer anonymous, decentralized, and deregulated. That's a massive philosophical shift for the crypto space, isn't it?
It really is. Okay, so CBDCs are one big part of the Group 1 picture. What about the other one you mentioned, regulated stablecoins? Group 1B.
Right, regulated stablecoins. These are another key piece of the puzzle Basel seems to approve of, but again, with very strict conditions. For a stablecoin to get into Group 1B, it has to jump through some serious hoops. First, there's what they call a redemption risk test.
Redemption risk test. What's that?
Basically, can it always reliably be redeemed for its pegged value, like 1-for-1 with the dollar, even in stressed market conditions? The reserves have to be sufficient and readily available. Second, the entity issuing the stablecoin has to be supervised and regulated itself. Subject to proper prudential rules, capital, liquidity, just like a bank.
Yeah.
No unregulated issuers allowed in Group 1B.
Okay, so proper backing, proper issuer regulation. What else?
The reserve assets themselves, they have to be super safe and super liquid. Think level one, high-quality liquid assets, things like cash, central bank reserves, top-tier government bonds, minimal market risk, minimal credit risk, and you need to be able to sell them fast without losing value.
So if a stablecoin is backed by, say, commercial paper or other crypto assets.
No, doesn't qualify for Group 1.
Yeah.
And crucially, stabilization mechanisms that rely on other crypto assets or use algorithms to manage supply, algorithmic stablecoins, they explicitly do not meet the Group 1 classification conditions.
That's a very clear line drawn in the sand, especially after some of the algo stablecoin blowups we've seen.
Absolutely. Basel learned those lessons, it seems.
So assuming a bank can create a stablecoin that meets all these tough requirements, what's the incentive for central banks to even allow commercial banks to issue them? Why not just push their own CBDCs?
That's a really insightful question. Why let private banks issue digital currency? Well, the likely model is that central banks will authorize a small number of sophisticated, well-regulated banks to issue these compliant stablecoins. But they'll probably require those banks to deposit an equivalent amount of actual fiat currency with the central bank as backing. It's a bit like how some commercial banks issue physical banknotes in places like Hong Kong or the UK, fully backed by central bank reserves.
Ah, I see. So the central bank still maintains ultimate control and gets reserves.
Exactly, and this mechanism can actually significantly increase a central bank's foreign currency reserves, especially if stablecoins pegged to its currency become popular internationally.
Which gives them benefits like more financial stability.
Yeah, bolstering financial stability, giving them more firepower for foreign exchange market interventions if needed. It's a way for central banks to kind of harness private sector innovation, but keep it on a very tight leash.
Got it. Okay, so CBDCs and highly regulated stablecoins are the favored children. And this all seems to connect back to the first thing you mentioned in Group 1, tokenized traditional assets. You said it's a potential win for banks.
Yes, absolutely. It all ties together, especially when you consider the other impacts of Basel III. Remember, Basel III wasn't just about crypto. It significantly increased overall capital requirements for banks.
Right, you mentioned the higher CET1 ratio from 2% to 4.5%.
Exactly. That, plus stricter liquidity rules like holding more high-quality liquid assets, has really increased banks' funding costs and squeezed profitability from traditional lending.
So they're looking for other ways to make money.
Precisely. They're heavily incentivized now to shift towards fee-based activities and get risky assets off their balance sheets, and asset tokenization is a perfect tool for that.
How so? How does tokenization help them shift?
Well, instead of making a big corporate loan and holding it on their books, using up capital, a bank could tokenize that loan into asset reference tokens and sell those tokens to investors.
Okay, so they originate the loan but don't hold the long-term risk or capital burden.
Exactly. Or they could help a corporate client issue its bonds directly as tokenized bonds, acting as an arranger or platform provider, again, earning fees without taking on the balance sheet risk. It reduces their asset size, frees up capital, and boosts that all-important fee income.
And connecting this to the bigger picture, you mentioned the sheer scale involved.
Yeah, think about the size of traditional markets. The global bond market alone is something like $133 trillion. If even a tiny fraction of that gets tokenized,
It would dwarf the existing crypto market capitalization.
completely overshadow it. We're talking potentially trillions of dollars in tokenized traditional assets flowing through systems managed or facilitated by regulated banks. This really disrupts the, let's call it the OG crypto market framework, doesn't it? Because suddenly these highly regulated traditional players are taking pivotal roles in the digital asset ecosystem, but focusing on assets that look very familiar, just in a new wrapper.
It really shifts the center of gravity. Okay, so that's the core Basel impact, pushing banks towards compliant assets, tokenization, away from unbacked crypto. But beyond Basel itself, 2024 is just a huge year for crypto policy generally, right? How are countries and international bodies reacting to all this? What does it mean for, say, U.S. leadership in crypto?
You're absolutely right. 2024 was monumental on the regulatory front, globally. We saw this massive shift from just writing frameworks in 2023 to actually implementing them in 2024.
Yeah.
Roughly 70% of the major jurisdictions reviewed, representing about 70% of global crypto exposure, made real progress on putting rules into practice. And over 60% introduced entirely new policies.
Where is most of this action happening?
We saw significant movement across Europe, the Middle East, and Asia particularly. Everyone seems to be trying to get their house in order.
And what were the other big trends besides just implementation?
Well, a huge one was institutional adoption. The approval of spot Bitcoin ETFs in the U.S. back in January 24 was a landmark moment.
Yeah, that felt like it opened the floodgates.
It did, and then Hong Kong followed suit, approving spot Bitcoin and Ether ETFs. It signaled a real shift, traditional finance leaning into crypto assets, even if the Basel rules make it hard for banks to hold directly. And alongside that, you just saw continued innovation everywhere. Regulators launching pilots, sandboxes, putting out calls for information,
Good.
trying to get a handle on things.
But it wasn't all smooth sailing, was it? You hear about winds of change, headwinds. How did things like elections, geopolitics, or even just regulators being overloaded impact the picture, especially in the US?
True, it wasn't all straightforward. Globally, crypto wasn't a top-tier issue in most of the 50 or so elections in 2024, but the U.S. election was definitely an outlier. There was a lot more focus on crypto policy there, hinting at potential shifts depending on the outcome. Within the U.S. specifically, you saw a lot of action on the enforcement front. The executive branch racked up a record $19 billion in settlements from crypto companies in 2024.
19 billion, that's staggering, including FTX.
Yeah, FTX alone accounted for about $12.7 billion of that. But it showed a real uptick in enforcement from agencies like the DOJ, FinCEN, OFAC, really cracking down on illicit finance in the crypto space, a very aggressive posture.
What about Congress? Any movement on actual laws?
There's definitely momentum. The Stablecoin Trust Act, aiming for federal licensing with strict rules on reserves and audits, is widely expected to pass sometime in 2025. And then there's the FIT Act, Financial Innovation and Technology Act. That one proposes a kind of dual regulatory system. The SEC handles tokens that look like securities, and the CFTC handles those that look like commodities, trying to draw clearer lines.
That clarity has been missing, hasn't it?
It really has. And then the courts weighed in too. The Ripple case was significant.
How so?
Well, the court made this distinction between Ripple selling XRP directly to institutional investors, which it said was an unregistered security offering, and sales made programmatically on public exchanges, which it said were not, because buyers didn't have the same expectation of profiting from Ripple's efforts.
Ah, nuanced ruling. That must have set precedents.
Absolutely. It gave some guidance, though maybe not as much clarity as everyone hoped, on how existing securities laws might apply differently depending on how a token is sold.
Okay, so the U.S. is active on enforcement, legislation, and in the courts. What about key moves elsewhere? You mentioned Europe, Asia.
Right, lots happening globally. The EU's big MiCA regulation came into force in two phases, June 30th for stablecoins and December 30th for crypto asset service providers, or CASPs. That's a huge comprehensive framework. Plus, their new anti-money laundering regulation, AMLR, is set for July 2027, which will also impact crypto.
And the FATF, the global anti-money laundering body.
Yeah, the Financial Action Task Force keeps pushing on the travel rule implementation globally. The reports highlight it's still a challenge. Some countries are slow to adopt the rules. There are issues with data quality.
That travel rule requiring sender and receiver info on transfers, it keeps coming up. It seems fundamental to regulation.
It really is. It's a core part of bringing crypto into the regulated financial system. We saw the UAE have success here. They implemented the travel rule properly in late 2023 and got taken off the FATF gray list in early 2024. Shows it can be done.
Interesting. Any other highlights globally?
Let's see. Switzerland is refining tax policies based on the OECD's crypto framework, and FINMA, their regulator, issued guidance on stablecoins. Australia is moving ahead with AML reforms, including the travel rule by March 2026. Japan continues its sort of pro-technology stance, even talking about Bitcoin ETFs and pushing Web3 development. And Korea launched its first big digital asset law, the Virtual Asset User Protection Act, focusing on consumer protection and market integrity. That kicked in July 2024.
So it really feels like a global wave of regulation, maybe not perfectly coordinated, but definitely moving in the same direction.
That's a good way to put it. The overall global trend is undeniably towards more comprehensive, more stringent regulation. Try to fit digital assets into frameworks, often inspired by traditional finance rules like Basel.
Okay, so let's try and wrap this up. Our deep dive today really highlights how Basel III is acting as this major force, pushing banks into a new era for crypto. It's about classification, strict capital rules.
Yeah, heavily favoring those compliant digital assets, CBDCs, the regulated stablecoins, tokenized traditional stuff.
While making unbacked crypto, like Bitcoin, almost prohibitively expensive for banks to hold directly on their balance sheets.
Exactly. And that pressure from Basel intertwines with this broader, rapidly evolving global regulatory push we just talked about. Jurisdictions are all trying to figure out their approach, but the direction of travel is clear. More rules, more oversight.
It brings us to a really interesting point, doesn't it?
It does. And maybe a final thought for you listening is this. As these traditional financial institutions get more deeply involved in digital assets, but under these very strict regulatory frameworks like Basel III, what happens next? Will this essentially force crypto innovation down a more centralized traditional path shaped by banks and regulators? Or could it actually spur a counter-reaction, a new wave of truly decentralized solutions designed specifically to exist outside this growing regulatory perimeter?
Centralization versus a new wave of decentralization. That's definitely something to mull over as you navigate, well, whatever comes next in this incredible dynamic space. Thank you for joining us on this deep dive.